Welcome to the Deep Dive. Today, we are tackling a truth that every single person who has ever looked at a price chart has struggled with: patience. We are diving into the art of waiting, specifically in the high-stakes world of trading, and really trying to extract the protocols that separate the consistently profitable from, the perpetually stressed.
It really is the ultimate counterintuitive reality of the markets, isn't it? Everyone who comes to trading is sort of conditioned to believe that more activity equals more success.
Right. More clicks, more charts.
Exactly, whether that's studying more charts or clicking more buttons. But the data we've synthesized from, professional trading firms reveals the brutal opposite. If you feel compelled to constantly click, you are quite literally actively draining your capital.
And we have to start with this specific reality revealed in the experiences we gathered, because this just defines the problem perfectly.
It really does.
We read the testimony of one trader who admitted to losing a significant sum of capital, an amount equal to several months' living expenses, in a single month.
Wow.
And the reason? Not poor analysis on a handful of trades, no. It was being driven purely by the adrenaline, the fear of missing out,
FOMO.
and taking a random trade every 5 minutes, just constant clicking.
That specific confession, it highlights the psychological severity of this barrier. That loss wasn't really a strategic failure. It was a result of impulse and, frankly, addiction replacing any kind of reasoned decision-making.
So our mission today is to provide you with the shortcut, if you will, to the secret that professional traders use.
It's not really a secret, just discipline.
True. We are fundamentally shifting the focus entirely from the quantity of trades you take
Forget the quantity.
to the extreme quality of the setups you wait for. We are replacing that impulsive gambling with disciplined, intelligent inaction. That's the
Wow.
goal.
Okay, so let's spend some time truly unpacking why this is such a universal struggle. We often frame it as a deficiency in our trading strategy, like, oh, I need a better indicator.
Right, blame the tools. But the impatience barrier, it's almost entirely psychological, isn't it? Why do we as humans struggle so much to simply sit on our hands and, wait for the optimal opportunity?
It's because the modern information ecosystem, it just works against our evolutionary wiring. The research we reviewed highlights what we started calling the social media pressure trap.
Ah, yes.
Think about it. You open your trading platform, and maybe you open your social media feed right next to it. What happens?
You're immediately bombarded.
You're immediately confronted with posts screaming $5,000 profit in one day. Or, look at my massive overnight portfolio gain. Constant noise.
And that instant visual stimulus, it triggers this destructive comparison game. If you're sitting there patiently waiting for an hour for your setup, the one-year plan dictates.
Which feels like an eternity.
Right. And someone online is flashing this massive green number, your brain immediately screams, you are failing. You are missing out on the opportunity that everyone else is capturing right now.
Exactly. This pressure creates a sense of mandatory participation. Almost like you have to be in the market. We start to believe we must constantly be in the market to succeed.
And this pressure, it leads directly to the core problem, the dopamine and gambling cycle.
Absolutely. For the impatient trader, trading stops being reasoned analysis. It becomes a series of high-stakes lottery tickets where the market feels like a giant slot machine.
And what happens when the slot machine pays out? Even a little. You hit a small win.
A green candle provides that instant physical dopamine hit. It's a powerful reward signal that instantly reinforces the preceding impulsive behavior.
So your brain connects the act of clicking with the feeling of reward.
Regardless of whether the trade was actually sound or just dumb luck, it doesn't matter at that point.
And conversely, when a red candle appears and the trade goes against you,
The immediate psychological trigger is frustration, anger maybe. This quickly morphs into what's commonly known as revenge trading.
trying to win it back immediately.
An aggressive attempt to instantly recoup the losses, usually by doubling down on an even poorer, even more impulsive setup. This rapid cycling between reward, frustration, anger. It turns trading into this vicious cycle of impulse and addiction.
It really does mimic compulsive gambling, not a professional pursuit.
Precisely.
And the physical manifestation of this impulse is what our material refers to as itchy hands. You feel it, right?
Oh, yeah. You detect movement, maybe a big, fast green spike, and the urge to jump in is overwhelming. Your brain says, now or never, get your piece.
And what usually happens, let's be honest?
You enter just moments before the market often reverses, catching you at the absolute top of the wick, right? Validating your impatience with yet another loss. It's painful.
And this brings us to the brutal contrast that every listener really needs to internalize. Look at the data comparing activity levels.
It's stark.
The retail trader, driven by these impulses, the social media pressure, the need for constant dopamine hits, often executes 100 or more random trades in a month. Easily.
They churn and burn capital, time, and mental energy. And when they inevitably fail, what do they often say?
The market is rigged. It's manipulated.
Exactly. They blame everything but their own lack of discipline.
But the professional trader, the one actually extracting sustainable value from the market, what's their average?
It's around 10 to 15 high-quality trades per month.
10 to 15. That means, what, 90% of their time is spent not trading.
Up to 90% of their actual market time is doing nothing but disciplined analysis, observation, and waiting. Just waiting.
Wow. That sheer disparity in activity proves a fundamental truth. Success in trading is fundamentally about limiting activity, not maximizing it.
Okay, so if we accept that premise, that success demands limitation, demands patience, the very next logical question is, what exactly are we waiting for?
Right. We can't just sit there vaguely hoping. We need a target.
We must move beyond feelings and define a clear, objective benchmark for what we call a high-probability setup, or HPS.
And the core definition you found is pretty non-negotiable, right?
Absolutely. An HPS is the precise moment when multiple confirmations align. It's not about seeing one green indicator flashing or one big candle suddenly appearing.
It's about confluence.
It's about a powerful confluence of factors, all signaling the same high likelihood outcome, everything pointing in the same direction.
The documents you pulled use a fantastic analogy for this, drawing from cricket, which I think really lands the point.
Yeah, it works well. A professional cricket batter doesn't try to smash every single delivery for a boundary, right? That's a recipe for getting out quickly. They wait. They wait patiently for that perfect ball that comes right into their hitting zone, the specific height, speed, angle that perfectly matches their strengths.
Yeah.
Then they commit fully.
And the market is constantly throwing deliveries at you. Constantly. Most of them are junk.
Most of them are what we call poor deliveries, choppy consolidation, low-volume spikes that go nowhere, unpredictable reversals, just noise.
Impatient traders swings at every single one.
Yeah.
And it gets wiped out.
While the patient trader knows the market delivers only a handful of those perfect balls in their zone each day, maybe even each week, and they must preserve their capital, their mental energy for those specific high-probability moments.
So to find that hitting zone, the trader needs a structure, a checklist.
Exactly. You must adopt a structural approach defined by a specific 5-point checklist. You need to be able to tick all these boxes before even considering pulling the trigger.
This framework becomes the external structure that replaces that internal emotional impulse you talked about.
Precisely. It's your objective filter.
Okay, let's break down those 5 critical confirmations that must align for an HPS to truly exist. What's number 1?
First, we start macro. Trend alignment. What is the overall market direction on the higher time frame, like the daily or weekly chart?
So if you're looking at a 15-minute chart for an entry.
Right. If you are trying to take a trade lasting maybe a few hours, but the daily chart is pointing sharply downward, you are immediately fighting the prevailing pressure. It's like swimming upstream.
Alignment means your short-term trade needs to be moving in the same direction as that dominant macro trend, or maybe against a trend that has clearly, confirmedly reversed.
If the trend isn't aligned, your probability is immediately cut, maybe in half. It's a huge headwind. So check the trend first.
Makes sense. Okay, second confirmation.
Second, support resistance confirmation. Are you near a critical psychological or structural level on the chart?
Those price levels where the market has turned before.
Exactly. Price levels that have previously caused major reversals, these SR zones, are where smart money, institutional money, tends to concentrate its activity. They become magnets for price.
So we're looking for price to test that key level.
And explicitly show signs of holding, rejecting it, or breaking through it decisively. If price is just floating around in the middle of a range miles away from these key structural magnets, you're basically trading in a statistical void. There's no edge there.
Got it. Third point. This one's often overlooked, I think.
Agreed. Third, and this is where technical analysis meets conviction, volume spike. A lot of retail traders, they focus only on price action, candles and patterns.
But volume tells you who is participating, right?
Volume answers a crucial question. Is the smart money actually participating in this move? Is there institutional backing? A breakout or a reversal signal that occurs on thin, low volume is very likely just noise. a fake-out designed to trap impatient traders.
But when high volume confirms the price action.
Then you know the institutional conviction behind the move is substantial. That volume spike is the proof of participation. It validates the move.
Okay, conviction check. Fourth, confirmation.
Fourth, we look for a clear candlestick pattern. Price action itself must give a visual, unambiguous signal at that key SR level, confirmed by volume.
So not just random squiggles. We need recognized patterns.
We're looking for recognized and statistically reliable patterns, like a bullish engulfing pattern right at a support level, or maybe a pin bar showing clear rejection of a resistance level. This is the visual trigger that crystallizes the intention of the market participants at that moment, giving you a defined, low-risk entry point.
Right, the final piece of the visual puzzle. And finally, the fifth, which you said is non-negotiable, the one that keeps your discipline honest.
Absolutely non-negotiable. Risk-reward ratio. Is the minimum potential reward at least twice the potential risk? Is the RR 1.2 or better?
1 to 2 minimum. Explain why that's such a critical threshold.
It's pure mathematics, the foundation of having a statistical edge over time. If you consistently risk $1 to potentially gain only $1, that's a 1.1 RR.
Which feels intuitive, maybe fair.
It feels fair, but mathematically, you need an extremely high win rate, well above 50%, just to break even after you factor in commissions, slippage, all the costs of trading. However, if you demand a minimum of 1.2 RR, risking $1 to make 2, you only need a win rate of approximately 34% just to break even. Think about that difference.
That's huge. It takes enormous pressure off needing to be right all the time.
Exactly. This dramatic shift in the required win rate is the single greatest structural advantage that patience gives you. It forces you structurally to wait for setups that have significant expansion potential, not just these tiny, fleeting movements. You're hunting bigger game.
So when you combine all 5, trend alignment, SR confirmation, volume spike, candlestick pattern, and that minimum 1.2 RR, what's the tangible benefit?
The probability jumps. The winning probability for that specific trade jumps dramatically from, say, a random 30-40% coin flip.
Which is where most impatient trades live.
Up to a much more defensible 60-70% probability you are deliberately stacking the odds in your favor by waiting for all these factors to align.
But here's the kicker, the thing that forces the patience.
Here is the scarcity realization that truly forces patience. These ideal HPS setups, where all 5 factors align perfectly, they are rare.
How rare are we talking?
They might occur only 2 to 3 times a day across major markets, if that. Some days, 0.
Wow. Only 2 or 3 real opportunities a day.
Right. Most of the market action you see flickering on your screen is just the noise that exists between these high probability zones. And you absolutely must learn to treat that noise as completely irrelevant to your capital preservation strategy. Tune it out.
Okay, so we've established the problem, the psychology of impatience, and we've clearly defined the target, the high probability setup.
Yeah.
Now we need the active framework. How do we actually implement this intelligent in action?
This is where we adopt the sniper analogy that the research really emphasizes. It's a powerful mental model.
Moving from machine gunner to sniper.
Exactly. The professional trader must fundamentally become a sniper, abandoning the machine gun approach of just firing indiscriminately at anything that moves.
So the sniper waits.
The sniper waits for absolute perfect conditions. No wind interference, clear visibility, the target perfectly framed in the kill zone, and critically, their written trading plan is the sole trigger.
Not emotion, not impulse.
Never. If any single condition outlined in their plan is missing, the trigger finger stays firmly off the weapon. No shot is taken. This mental shift, it's mandatory for survival in this game.
The sources you shared provide a really powerful personal anecdote that perfectly illustrates this pivot. From quantity to quality, under duress almost.
Yes. This story really drives it home. This trader was apparently highly successful during a rampant bull market phase, trading like crazy.
How many trades?
15 to 20 times daily, just constantly in and out, racking up quick gains, what he called easy money. He made thousands of dollars very quickly and naturally felt invincible, like he'd cracked the code.
Uh-oh, I sense a bud coming.
But then the market correction hit. Suddenly, those 15-20 daily trades, the same strategy, went completely sour. He started hemorrhaging money.
How bad was it?
The trader lost tens of thousands of dollars in a matter of weeks, just wiped out a huge chunk of his capital, mentally and financially devastated.
Right, so what happened?
His mentor intervened. The mentor realized the problem wasn't the core strategy itself, but the sheer volume of trading, the constant exposure to market noise.
So the mentor forced to change.
Forced a radical constraint. The trader was allowed only 5 trades per week.
Wow. Not 5 a day, 5 per week.
Per week. That is the ultimate enforcement of scarcity, right? You cannot afford to waste a single bullet when you only have 5 for the entire week.
So what was the result of this extreme constraint?
The result, by focusing purely, intensely on identifying only those 5 absolute A-plus setups, applying that HPS checklist meticulously, the entire loss was recovered within the next 2 months.
Incredible. That's empirical proof right there.
Quality trumps quantity every single time. Less is truly more in this context.
Okay, so let's break down the 3 core steps the research suggests for enforcing this sniper discipline in our own trading. Step 1 seems foundational.
Absolutely. Step 1 is the bedrock. Define your edge. Crystal clear strategy. If you cannot articulate your specific repeatable edge in a single written sentence,
Oh, you don't really have one.
you are merely hoping. You're gambling, not trading with a statistical advantage.
So this edge needs to be written down, like physically written.
Written down, specific, and defining your trading type. Are you strictly a breakout trader? Do you specialize in mean reversion? Are you a trend follower?
The research detailed a specific example for trend following, didn't it?
Yes, a clear example was trade only stocks making higher highs and higher lows on the daily time frame where the relative strength index, RSI, is in the 40-60 range.
Very specific.
Let's unpack that RSI range. Why, 40 to 60, that seems counterintuitive maybe? Not overbought or oversold.
Exactly. That specific range signals healthy, controlled momentum or maybe controlled consolidation within a strong established trend. It forces patience.
How's that?
It actively prevents the trader from chasing euphoria when the RSI is screaming over 70, overbought, and it stops them from trying to catch a falling knife when the RSI is below 30, oversold.
So by setting that specific 40-60 range, you must wait for the stock to pull back or consolidate calmly before you can even consider entering. Precisely. It eliminates the impulse to chase that big green candle that's already extended. It forces you to buy the dips in an uptrend or sell the rips in a downtrend, which is generally a higher probability entry.
Okay, clear edge defined and written down. Step 2, this one comes directly from that anecdote.
Step 2 is implementing that crucial artificial constraint, the 3-strike rule.
3 strikes and you're out for the day.
Basically, you identify only the 3 best opportunities per day that perfectly meet your written HPS criteria. If you miss those 3 for some reason, or if the market simply fails to deliver any setups meeting that high standard,
Your trading day is over. Shut it down.
the day is over. No chasing mediocre setups, no revenge trading, trying to make up for missed opportunities. Walk away.
The key here is adherence, though, right? What defines a strike?
Good question. A strike is defined as a setup that passes your entire 5-point HPS checklist. It looks perfect on paper, but for whatever reason, maybe the required stop loss was just too wide for your risk rules, or perhaps you were distracted for a moment, you didn't take the trade. If you identify 3 of those amazing opportunities and fail to act, or if the market just chops sideways all day delivering nothing, you walk away. This constraint completely eliminates that psychological pressure to somehow manufacture trades out of sheer boredom or frustration.
Powerful.
Yeah.
Okay, step 3. This one sounds like a game changer for impulse control.
It absolutely is the pre-market ritual. You must dedicate 30 minutes before the market even opens to focused preparation.
Your planning time.
Yeah.
Your war room.
Exactly. This ensures that all your potential trading decisions are made with a clear, rested mind, significantly reducing the need for panicked, reactive decisions later in the heat of the market battle.
Makes sense. What are the mandatory elements of this ritual?
3 key things. First, create a watch list. Don't try to watch the whole market. Pick 5 to 10 highly liquid instruments that are already near your specific setup conditions. Maybe they're hovering near key support or resistance. Focus your attention.
Okay, narrowed focus. Second element.
Second, you must decide entry, stop loss, and target beforehand for each potential setup on your watch list. Know exactly what your risk exposure will be and what constitutes a successful outcome, your 1.2 or better target, before the market opens.
Plan the trade completely. And the third part. This sounds like coding almost.
It's about pre-commitment. Third, you must write out if-then scenarios. Literally write them down.
Give me an example.
Like, if the Nifty Index breaks 23,500 resistance with high volume, and my chosen stock's RSI is confirming between 40-60, then I will take this specific long trade with this predetermined stop loss at X and target at Y. If these conditions are not met, I will do nothing.
So you're programming your response in advance.
Exactly. Planning the action removes the emotion from the reaction. You essentially turn yourself into an automated execution system for your own plan once the opening bell rings.
Okay, intellectually, this framework, the sniper mindset, the rules, it all makes perfect sense. But let's be real, the hardest part is the actual waiting game, isn't it?
Absolutely. That 60 to 70% inactivity window we talked about, it can be mentally excruciating, especially when the market is moving, maybe chopping around, and crucially, when you see others online posting apparent profits.
That FOMO kicks in hard. So we need practical tools, techniques to actually manage that emotional impulse to just click something.
Agreed. The first technique is a really simple but surprisingly effective emotional mitigation tool. It works directly against that primal surge of FOMO, we call it the screenshot test.
Screenshot test. Okay, how does it work?
When that FOMO strikes and you feel that physical itch, that urge to enter a seemingly fast-moving trade that doesn't quite meet your rules, pause. Take a screenshot of the current chart setup. Capture that moment.
Okay, got the screenshot. Then what?
Then force yourself to wait 15 minutes. And don't just sit there staring at the live chart. Actually stand up, walk away, make a coffee, briefly review your written pre-market plan. Create a small gap.
Why 15 minutes? What does that do?
That 15-minute pause acts like a psychological circuit breaker. It provides just enough time for your prefrontal cortex, your rational decision center, to regain control from your amygdala, the part of the brain firing off fear and immediate impulse signals.
Letting the rational brain catch up with the emotional brain.
Exactly. When you return after 15 minutes and calmly look at that static screenshot you took, the research and anecdotes show that in up to 70% of cases, the market has either pulled back sharply, violently reversed, or just gone nowhere.
And you realize.
You realize that jumping in would have been a poor entry, a potential loss avoided. That intentional pause converts that raw emotional impulse into rational, protective thought. It builds the patience muscle.
I like that. Simple, actionable. Okay, technique number 2 involves the trading journal, but with a twist.
Right. Technique 2 is turning your journal into an honest mirror for your discipline. The trading journal focusing on avoided trades.
Most people just log P&L, right? Wins and losses.
Yes, they focus on the trades they took. Professional traders, however, place equal, if not sometimes greater, value on meticulously journaling the trades they consciously avoided.
Why is documenting non-trades so important?
Because it provides crucial psychological reinforcement for patients. You actively note the setup you almost jumped into impulsively. You document why it failed your HPS checklist. Maybe there was no volume confirmation. Maybe the RR was terrible.
And then you track what happened next.
Yes. You track what happened to that setup after you patiently stayed out. Seeing in black and white that your disciplined patience saved you from a loss provides concrete, positive data reinforcement that patience is itself a profitable action.
So you document the setup quality, the entry rationale you considered.
And most importantly, you honestly assess whether the trades you did take were patient and plan-based or impulsive. Reviewing this data over time will inevitably prove to you that your patient, rule-based trades consistently yield a dramatically higher win rate. It builds conviction in the process.
And you also suggested incorporating paper trading alongside this, specifically for new setups.
Yes, especially when learning a new strategy or refining your edge, paper trading allows you to build the muscle memory required for patience on that specific setup without financial risk breathing down your neck.
Practice waiting without the pressure.
Exactly. You practice the discipline of waiting for all 5 confirmations to align perfectly, knowing the only cost of impatience is a wasted paper trade, not real capital that impacts your rent or groceries. It lowers the stakes while you build the skill.
Okay, this next one sounds intense. Technique 3, the One Trade Wonder Challenge.
Yes, this is for a rigorous application of quality over quantity. It's a challenge. Take a week. Just 1 week, and commit to taking only one single best trade.
Not one trade a day. One trade for the entire week.
One single best trade. Not just a good trade, the absolute best A-plus setup the market presents according to your rules. This imposes maximum critical choice.
You only get one shot.
You're forced to apply the entire HPS checklist and the sniper mindset with absolute surgical precision. There's no room for pretty good. It has to be perfect. It completely eliminates impulse trading for that week because the opportunity cost of wasting your single shot is too high.
That sounds like a fantastic reset button for discipline. Finally, Technique 4 addresses a root cause of FOMO.
Yes, we need to tackle the primary trigger for FOMO for many traders: continuous, uninterrupted screen watching. just staring at flickering candles for hours on end.
Which leads to fatigue and bad decisions.
We recommend adopting Pomodoro for traders, chunking screen time. The Pomodoro technique is usually for productivity, but it applies perfectly here. Studies show that prolonged, continuous screen time leads to decision fatigue and neurological exhaustion, dramatically increasing impulsive behavior. You just get worn down.
So how do you apply Pomodoro to trading hours?
You deliberately divide the market hours into focused chunks. For instance, maybe a focus session from 9:15 to 10:00 a.m., watching the opening range dynamics. Then a mandatory 15-minute break away from the screen, walk around, review notes, whatever.
Then maybe another focused chunk later.
Right. Then perhaps 11:00 a.m. to 12:33 p.m., focusing on mid-session potential reversals or trend continuations, followed by another break. By limiting continuous screen time, you reduce the sheer volume of market noise your brain has to process.
Less noise equals less FOMO.
Less noise, less fatigue, less FOMO, preserved cognitive energy for when a real HPS appears. And within each focus chunk, you limit your active search to just 1 or 2 high-probability opportunities that meet your criteria, rather than feeling like you have to monitor the entire market universe constantly. Focus your energy intelligently.
Okay, we've got the framework, the tools. But underpinning all of this is a fundamental mental shift, isn't it? We have to change how we even think about trading activity.
Absolutely. This brings us to the most crucial component, really. The internal mental shift required to sustain this discipline over the long haul. Mindset realization number 1 is deeply counterintuitive for most people. Intelligent inaction.
Meaning, doing nothing is actually doing something productive.
Precisely. We are conditioned in almost every other aspect of life, sports, career, fitness, to believe that more activity equals better results. You want to lose weight, you exercise more. Want a promotion, work more hours. It's deeply ingrained.
But trading is different.
Trading operates on a completely opposite principle. More activity, especially impulsive, unplanned activity, almost always correlates directly with more loss. Trading success is fundamentally predicated on choosing intelligent inaction over constant participation. Your ability to patiently do nothing is your primary edge.
That's a huge realization. And that leads directly into mindset realization number 2, which might sound strange at first.
Right. Boredom is your friend.
Boredom. We usually try to avoid boredom.
In life, maybe, but in trading, if your trading feels exciting, if your heart is pounding before you click, if there's a rush of adrenaline flowing, that's actually a powerful warning sign.
A sign of what?
A sign that you are operating as a gambler, seeking thrills, not as a professional executing a plan. Professional trading, built on patiently waiting, meticulously checking 5 rigid rules, and following a specific written plan. It should ideally feel repetitive, mundane, and yes, quite often, boring.
So that profound boredom is actually good.
That profound boredom is statistical proof that you are adhering to your edge, that you're filtering out the noise, that you're waiting for the HPS. Excitement means you're likely deviating from the plan and taking unnecessary risks. Embrace the boredom.
This philosophy, this whole idea of patience, it's echoed by the greats, isn't it?
Perfectly summarized by the great oracle of patience himself, Warren Buffett. He famously stated, "The stock market is a device for transferring money from the impatient to the patient."
Simple, brutal.
It's essentially a zero-sum transfer mechanism in the short term. Every time you trade impatiently based on FOMO or a hunch, you are effectively volunteering to transfer your capital to the disciplined few who are patiently waiting on the sidelines for their defined edge to appear.
Okay, let's make this concrete. Let's contrast the two approaches, impatient versus patient, using a hypothetical chart scenario. Maybe for a well-known liquid instrument over a single trading day. How does it play out?
Great idea. Let's consider the impatient trader. They log on, maybe around 9:30 a.m., full of hope and energy. They see the first 15-minute candle is green and moving up fast.
What do?
They jump in immediately. Their thought process is, the momentum is here, I can't miss this move. They enter without checking volume properly, without seeing if it's near a major resistance zone, just pure momentum chasing.
In that.
45 minutes later, maybe an hour, the initial spurt fades. The price rolls over, turns red, and they hit their stop loss. A classic whipsaw loss right out of the gate.
Okay, loss number 1. Now frustration sets in.
Exactly. Frustration kicks in. They feel they need to recover that loss now. They see a minor bounce around, say, 11:00 a.m., this is the revenge trading impulse kicking in.
Is it a good setup?
No, it's a weak setup, maybe low volume, right into resistance, but they re-enter anyway, desperate to make the money back, only to be stopped out again as the market remains choppy and directionless.
So they end the day how?
They end the day with maybe 2, 3, or more avoidable losses. But just as importantly, they end with complete mental exhaustion, maybe anger, and a reinforced belief that the market is too volatile or against them.
Okay, that's the painful picture. Now paint the picture of the patient trader on the same day, looking at the same instrument.
Right, the patient trader. They also began the day at 9:15 a.m., but they started with their pre-market ritual. They have a preset if-then plan.
What might that plan sound like?
Something specific like, this instrument is consolidating near its key 2850 support level. I will only consider entering long if this support holds definitively 8E. The price decisively breaks the resistance at 2870 with significant sustained volume confirmation. My target will be a minimum 1.2 risk-reward ratio from my entry.
So, very specific conditions. What happens during the morning?
From 9:15 a.m. until maybe 12:00 p.m. or even later, nothing happens that meets those strict criteria. The market is consolidating, chopping around in that poor delivery zone we talked about. There's noise, but no signal.
And what is the patient trader doing during these 3 hours?
They're observing calmly, maybe reviewing their journal, maybe doing the screenshot test on tempting but flawed moves, but their fingers firmly off the trigger. They are actively engaging in 3 hours of intelligent inaction, trusting their validated plan explicitly. No stress, no impulse.
Okay, so they're waiting. Waiting, then what?
Then, let's say around 12:45 p.m., the confluence finally happens. Volume spikes dramatically on the chart. The 2850 support level has clearly held all morning, absorbing selling pressure, and then boom, 2870 resistance breaks with a strong, confirmed bullish candlestick pattern. All 5 HPS boxes are checked simultaneously.
The signal arrives.
The signal arrives. The patient trader executes their pre-planned trade, enters long at, say, 2872, sets a tight, predetermined stop loss just below the breakout level, maybe around 2860, and sets their profit target up towards 2900 or higher to meet the 1.2 RR requirement.
And the outcome?
They potentially achieve a single, clean, high-probability 1.2 risk-reward trade. They might be done for the day by 1:30 p.m. The result? Profit, yes, but more importantly, complete mental peace. They only spent maybe 30 minutes in active trade management compared to the impatient trader's 3 hours of frantic, stressful, loss-making activity.
The difference isn't necessarily analysis skill.
Often it's not. The difference is the timing, the discipline, and the unwavering adherence to the process of waiting for quality over quantity.
Okay, this is crucial though. We have to address the inevitable reality check. What happens when you do everything right? You wait patiently for that perfect HPS. You meticulously check all 5 confirmations. You follow your written plan perfectly, and you still take a loss.
Yes. This is the moment, isn't it? This is when patience is truly tested at its core. And it's the moment most people abandon their discipline and revert right back to impulse.
Because it feels like the patience didn't work.
Exactly. It feels like a betrayal of the effort. But this is where the mindset absolutely must be anchored firmly in the process, not in the short-term, random outcome of any single trade.
So how do you judge success then, if not by the P&L of that one trade?
You must judge your success based purely on your adherence to the process. If you followed your high-probability setup rules to the letter, if you waited patiently, if you executed according to plan, you were successful, even if that particular trade resulted in a loss.
Because you were trading statistically.
You are trading statistically. In a setup with a 65% probability of winning, the 35% low probability outcome, the loss, will still occur roughly 35% of the time. It has to. Otherwise, it wouldn't be probability, it would be certainty.
Right. You can't view the loss as some kind of moral failure of your discipline.
Absolutely not. Your rule-based, patient approach is designed to protect you from catastrophic losses and give you an edge over time. It doesn't and cannot guarantee that every single trade is a winner. Think about professional athletes. They miss thousands of shots, thousands of swings over their careers.
They weren't failures for missing.
No, they were failures if they stopped taking the high percentage shots their process dictated they should take. Your loss is just a data point. It validates your risk management model, confirms the probabilities are playing out. It is not a reason to abandon the very discipline that gives you that edge.
Okay, but psychologically, taking that loss after being so patient is tough. What's the biggest danger then?
The biggest psychological danger is immediately abandoning the disciplined approach out of sheer frustration or disappointment and moving straight into impulsive revenge trading to make back the loss. That's where small losses turn into huge ones.
So we need a protocol for recovery, a way to handle the setback constructively.
Yes. This is where having a defined recovery phase protocol is essential. It helps you regain confidence and get back on track without breaking the framework that protects you.
What are the steps in this protocol?
First, and immediately after a confidence-shaking loss, or series of losses, reduce trade size significantly. Play small.
Why is that the first step?
It's a critical psychological reset. Lowering the capital exposure immediately reduces the emotional pressure, the fear of further loss. It gives you the necessary mental bandwidth to focus purely on execution quality and rebuilding patience without the heavy stress of losing large sums hanging over you.
Makes sense. Take the pressure off. What's next?
Second, during this recovery phase, take only easy, obvious setups. Avoid anything complex, borderline, or requiring fine judgment. Only pull the trigger on the absolute A+++ trades where the HPS alignment is undeniable, crystal clear.
Aim for the layups, not the half-court shots.
Exactly. This is about maximizing the probability of small successes to rebuild confidence and minimizing mental effort while you're potentially feeling fragile.
Okay. Step 3 in recovery. This one seems important for breaking bad habits.
It's very important for regaining psychological control. Remove daily profit targets. Completely get rid of any monetary goals for the day or week.
Why? Don't goals help?
Not in this phase.
Right.
Focusing on a specific P&L number forces impatience. It incentivizes taking bad, low-quality, volume-driven trades just to hit the number. Instead, your only goal during recovery is to execute your process correctly, follow your rules perfectly, regardless of the outcome. The money will eventually follow the correct process. You don't need to chase the money itself.
Focus on process, not outcome. And finally,
play small until confidence returns. And use this period not just to trade small, but to actively rebuild your discipline muscle memory. You are proving to yourself, through a series of small, successful, rule-based actions, even if the trades are small wins or small managed losses, that you can follow the rules consistently, regardless of the P&L setback you just experienced. You rebuild trust in yourself in the process.
Okay, that's a solid recovery plan. Now, to bring everything we've discussed today together for the listener, to make it super actionable, you've synthesized this entire framework into a simple daily checklist.
Yes, a straightforward 5-point daily list we're calling the 5-step patience protocol. This is your daily guide to implementing everything.
Let's run through it. Step 1.
Step 1. Define morning. Before the market opens, during your pre-market ritual, identify your focused watch list, maybe 5 key stocks instruments, and write down the exact entry conditions, HPS criteria, RR requirement, and stop-loss placement for potential trades on each. Be specific.
Got it. Prep work done. Step 2.
Step 2. Wait. Market hours. Screen is on, but your trigger finger is off. This is the active period of intelligent inaction. Observe, monitor your watch list for your conditions. Apply the screenshot test if FOMO or temptation arises. Embrace the boredom.
Wait for the signal. Step 3.
Step 3. Validate before entry. When a potential setup appears on your watch list, meticulously check all 5 confirmations of your HPS checklist: trend, SR, volume, pattern, RR. If even one confirmation is missing or weak, the trade is disqualified. No exceptions. Stay out.
Strict validation.
Step 4. Execute when ready. If and only if all 5 HPS conditions are met, then execute your pre-planned trade precisely. Enter at your planned level, set the predetermined stop loss, and target immediately upon entry or just before. You are simply executing a pre-committed order based on validated signals. No second guessing.
Follow the plan. And the final step after the market closes.
Step 5. Reflect after market. Journal your trades taken, yes, but even more importantly, assess your patience for the day. Did you stick to the 3-strike rule, if applicable? What trades did you consciously avoid, and why? What did you learn from your adherence, or lack thereof, to the patience protocol today? This reflection cements the learning. #tag outro.
Wow. Okay, this entire deep dive, it really brings us back to one central, powerful truth, doesn't it?
It really does. Patience isn't some kind of mystical gift or personality trait you're either born with or not. It is a practiced, measurable skill. It requires conscious effort and structure, and ultimately, it is a defining feature that separates consistently successful traders from those who perpetually struggle and fail in the long run.
And maybe the ultimate rule for risk mitigation, especially when that impulse threatens your discipline. Because we have to remember, the simple act of avoiding a bad trade is in itself a profitable action.
Absolutely. It's capital preservation. So the final rule, perhaps, if in doubt, stay out.
Simple, effective.
If the setup isn't crystal clear, if it doesn't tick all 5 boxes, if the RR isn't compellingly in your favor, at least 1.2, if you find yourself relying on hope or gut feeling, or if your hands start getting that familiar itch, just stay out. Do nothing. Preserve your capital for the true A+ opportunity.
So maybe a final provocative thought for you, the listener, to take away and really mull over.
We encourage you to reflect deeply on the long-term compounding cost of constant impulsive trading. The financial losses, yes, but also the mental exhaustion, the mounting fees, the stress, the time wasted. Compare that cost.
To the long-term compounding benefits of strict discipline, surgical entry based on validated signals, and the power of intelligent inaction. Think about the mental piece, the capital growth, the sustainability.
Trading, when done professionally, is not a series of short, exciting sprints. It's a marathon of discipline. And the market ultimately always rewards patience, not frantic participation.
So ponder this. If your current trading style feels consistently exciting, maybe even thrilling, you're likely treating it like a short, dangerous sprint, prone to flame out.
But if you can shift your focus, embrace the necessary boredom, follow a structured protocol, and patiently wait for that perfect confluence, you transform yourself from an impulse gambler into a disciplined professional, truly ready for the long race ahead.